Well, let's get across the market opening. Kerry Craig joining us from JP Morgan. Kerry, great to have you back on the show. Thanks for joining us. Let's start with what we're seeing at a macro level, particularly those moves by central banks. Now, we've seen this locally, of course, with indications perhaps we may be close to the end of the cutting cycle.
Yeah, good morning, Andrew. That's right. So we've had obviously the RBA, who's become a little more hawkish given their outlook and their new set of forecasts around growth and inflation into the middle of next year. We've heard from the European Central Bank more recently, and they're seeming fairly comfortable with where they think the rate is at the moment. Bank of England coming up there, a little bit more hesitant. They've obviously got some different issues there, given the way the budget may be looking for some fiscal consolidation. And then Bank of Japan, there's no real indication you might see a movement from the Bank of Japan higher, given the change in Prime Minister there. And the outlier, obviously, is the Federal Reserve, which is dancing in the dark to a certain extent, given that there isn't much official data to come through. So it does feel like central banks are now either coming to the very end of their rate cutting cycle, or in the case of the Fed, maybe doing a little bit more of a pause before it does more next year. So I think for markets who have been factoring in a lot of policy easing, they'll still be looking for loose financial conditions and looser monetary policy than we have been, but also thinking about the fact that the economy is now at a point where inflation is getting back to more normalized level outside of the US, and thinking about the growth prospects coming through in the economies around the world, and how that's supporting the outlook for markets as well.
All right. Well, how supportive is that, particularly for various those assets? First, with fixed income, what do you see there?
We still see the prospect of more bias to rate cuts than rate hikes in this environment. There's always shocks to the downside to the economy that could present themselves, and most notably through the labour market. And that's how central banks would respond when they do think about growth and inflation when they're setting policy rates. And so that is more biased towards thinking around positioning in fixed income and moving a little bit further along the curve, particularly in the US, towards more, the 5-year part of the curve rather than the very short end of the curve. It also means we expect to see continued steepening in yield curves, which is a big feature of what we've seen in 2025, as the markets contend with potentially looser monetary policy being the bias, but also thinking about the implications of that fiscal spending in the US and others. And also thinking about the fact that inflation still has the potential to be a little bit stickier, and so not wanting to move out in terms of the very long part of the curve, keeping curves a little bit steeper. But overall, it means fixed income, which is still paying you 4% interest in the US and in Australia, is providing income to a portfolio, and is also providing some more downside protection if there was a shock and those yields should fall. So more appealing overall from a portfolio construction point of view.
And Kerry, how do you see it playing out for equities? First, focusing on what we're seeing on Wall Street, given we're also obviously in the midst of those earnings results.
Yeah, the markets have been a bit jittery this week. Again, when there's not much economic data available, they tend to focus on the micro a little bit more. And so the earnings numbers coming out of the US have been key for that. A few shakes of that this week with some of the big mega cap names and digesting their earnings announcements, and just sort of illustrates the point where we tend to group the sort of Magnificent Seven or Magnificent Six companies together. They're actually quite different in terms of how they're operating and how their outlook's coming through. More broadly, though, the earnings numbers have been very supportive. So the earnings growth that we're tracking is in sort of the low double digits based on what companies have reported and those still expected to report for year-on-year earnings for the third quarter. And a lot of that growth is coming from those mega cap names. So if we think about what we're seeing for the full year for 2025, it's about 21% earnings growth for those Mag 7 and about 8% for the rest of the market. And a lot of that rest of the market is things that are associated with AI, so the industrial side of things, the utility side of things. So it does lean towards still favouring some of those mega cap names when it comes to supporting the earnings outlook and those valuations that have crept up. So this week we saw a little bit of nerves around the valuation being called into question. That's come back, and I think you've seen the market recover from that sell-off, again suggesting the support there, the market just being a little bit more sensitive to those valuations. But as long as that underlying earnings picture is strong, we do believe in the more secular theme around AI being more prevalent, and something that investors should have exposure to in their portfolios.
Yeah, obviously questions about those valuations, Kerry, where they've gone to a speculation that Wall Street is in an AI bubble. What are your thoughts in that regard, and just how cautious would you need to be?
I think you have to be cautious anytime the valuations get to what can be somewhat stretched levels. So in the case of like, is it a bubble? We can go back and compare to what we saw in the late 90s, early 2000s and say, well, back then there wasn't the earnings growth. You were using a lot more subjective measurements to justify the valuations of these companies, whereas here now you're actually seeing genuine earnings growth come through. You can see the demand coming through. I think the real issue comes around the level of capex, the announcements around some of these numbers being so large, and that movement away from it being funded by, quite fairly hefty cash piles to now including some leverage and the fact that there's use of debt, which sort of somewhat dilutes some of the story there. But I think those levels are still very low. And the fact that we are seeing that earnings supportive does downplay some of that idea about the bubble. And it does seem like it's more of the capital chasing AI than AI chasing the capital at this point in time, which does seem more favorable for the outlook. And you can see it broadening out through the different economies, through how we think about the adoption of AI across different sectors, and really how it could be much more beneficial long run in terms of the economy, productivity, than perhaps what we've seen in the past when some of these technology stocks became a little bit highly valued.
And Kerry, I see you say if you're looking for some further diversification, emerging markets perhaps not a bad place to look. What's the opportunity you're seeing there?
I think it's an area, whether it's emerging market equities or emerging market debt, it's been fairly under-owned by many clients. It's been somewhat of an asset that adds volatility to a portfolio. There's been lots of concerns around the outlook for China, which is a big weight within the emerging market equity index. And then obviously, as there was concerns around the direction of rates in the US dollar, that doesn't bode well for the emerging market debt outlook. However, now you're seeing obviously a different way to play the tech theme through China tech, which we've seen doing very well. And you can play that through both the sort of onshore market or thinking around the Hong Kong market. We are seeing some supportive measures for the Chinese economy, albeit slowly coming through on the growth side and support for the domestic consumer. So we do expect that to be beneficial for the outlook for the emerging markets. And then on the central bank side, we've seen policy easing come through as they're less concerned around the movements in the currency, given that we have had that weakness in the US dollar, which admittedly has been a little bit more tempered with a rise more recently, but projections thinking about a falling US dollar from falling rates in the US and that movement of capital away from US assets to the rest of the world should see sort of US dollar depreciation that bodes quite well again for emerging market equity and debt performance. So we see it as another way to both add growth in a portfolio from the equity side of things, and also thinking about the income generation from the debt side, where we see a bit more value coming through a bit more value on the emerging market debt side, given the tightness we've seen both in spreads and emerging and investment grade and in high yield bonds in developed markets.